Hello and welcome to the Portfolio Podcast. On this week's episode, we're going to be looking at our Getting Started guide. Now, this week's a really special one because this is the first part of how we trade, our strategy. Let's get on with it. So in this episode, we're going to talk about four things pretty much. We're going to talk about what actually is dividend investing. So some of you have probably seen things like GameStop investments and that sort of thing. And then you've got your cryptos, that sort of thing, and even Forex. But what is dividend investing? What key terms do you need to know? And also what content and concepts do you need to understand before you can dividend invest in a intelligent way and not just a hit and hope kind of 50-50, which way is it going to go kind of way. And finally, how are these concepts and terms and techniques going to make you money? What are dividends? A dividend is the payment of some publicly traded company's profit that a stockholder gets a proportion on based on the amount of shares they own. Now, investors obviously expect a profit on their investment, but this can be done in one of two major ways, and that's either the growth of the value of the share or the dividend that's paid out per share. Companies that are not dividend paying are usually reinvesting the money into projects or growth of their business, essentially to make that share value increase. This is equally as good as the share price will rise and you still get that profit, but as dividend investors look into our future rather than earning money now, we look to the more mature companies that have kind of completed their large growth period of their life, and they'll pay the dividends, and a lot of them pay quite handsome dividends. But you will find that many tech companies have a lower dividend, and that's quite obvious because tech is obviously always growing. We're always having to reinvest into new technologies and new research. So you will find places like Microsoft and Apple will either be in the 2 to 3% range or even down at 0%. Start seeing dividends coming into your trading account. You just to own shares in a company before the ex-dividend date. If you invest after this date, you won't be eligible for the upcoming payment, but you will be able to collect the following dividend payout in, say, a month, quarter, half year, or year's time. At TPP, we use dividendmax.com. We have no affiliation with them. It's just a great site with a free account to see the ex-dividend date and previous payout timescales. This allows us to see if the stock pays out monthly, quarterly, or yearly, and a kind of an estimated yield percentage, and then also an accuracy measurement as well. You do get more information with the paid subscription on the website, so it is worth checking out the free trial. There's no credit card information needed to try it out, but do recommend it.
I have looked at the paid one a few times already, and it's
Yeah.
I love the website. It's great. It gives me the basic information to use, and it'd be great to get the reminders rather than having to chase things down yourself. But when you're looking at it, it's like I think it's like £9 or £15 a month. It's like, oh right, okay, that's
Quite a lot.
fairly big chunk of your investment, especially like yourself when you've just started out. That's your entire dividend payments gone for the year just on an account.
I do need to do a bit of a disclaimer before we carry on with the rest of the episode. So at TPP, we are only speaking from our own opinions and experiences. This information is for learning and entertainment purposes only, and you should always do your own research before investing. We're not a financial institution and do not take any responsibility for losses that may occur due to the following the information in this video/audio. The responsibility of the viewer's investment choices, gains and losses are yours only. Please invest responsibly. So we're going to look at the different concepts that you need and different terms that you need to understand dividend investing properly. So the first one we'll look at is good dividend paying record. Now this is how has a company been paying their dividends over the course of the last 5, 10, even 15 years. I mean, on Dividend Max, as you can see on the screen now, this graph shows you a nice trend upwards with a few blips downwards. This is just a random one that I pulled from the site. Now others will be steady and won't have changed in years, and some will be trending downwards. We want to see this trend preferably moving upwards because that's great for us, seeing that yield increase. Mm-hmm. Staying steady or somewhere in the middle. You know, if there's a slight tick up every now and again, that's still good, you know. Mm-hmm. But if we're seeing a downward trend, then there's a worry that will continue to get smaller, and that percentage you're getting each year from that company is getting reduced, and that's just destroying our potential earnings, which is not what we want.
Yeah, you have got to have a look. Sometimes you have got to look into what the reason for the dips are. So a really good example of this is Penn Group. They did a sold off part of their company. Now they'll have a massive spike on their dividend graphics as part of that. They paid out a special dividend that was worth like 30% of their shares, so they'll have a huge spike on their graph. But then in the following years, because their company's now scaled smaller, they won't be paying out as much dividends. So it will show us the dividend in terms of cost has gone down, but the actual yield against the now lower share price because of the special dividend is theoretically the same, if not higher. So
Yeah.
sometimes it's good to have a good
Yeah, of
dive
course.
into why the dips on the graph or peaks
Yeah.
on the graph are there.
Yeah. So if there's a massive increase in one of the graphs, then that probably could be a special dividend.
Mm-hmm.
But generally, you'll see them either steady incline, steady, or steady decline. We just got to watch for those steady declines in reality, because we want to earn money, not continuously earn less money each year. So we're going to look at the second concept, which is steady revenue and earnings growth. Okay, so this is going to require you to look at the financials in the annual and quarterly reports. Okay. What we're looking for here is for increases year on year or even quarter on quarter of revenue / and or profit. If revenue's staying the same and profit's going up, or revenue's going down but profit's staying the same, then they may be looking at like cost saving or becoming more efficient, trying to save money in any way they can, which is not a bad thing. If their revenue is staying the same, make sure you look at that profit and loss statement at the bottom and see what's actually going on. See if they're paying off debts, that sort of thing. Make sure that this debt that they've had for 10 years that they're now paying off pretty quickly, this could be a really good thing because they're becoming cash positive soon. So make sure you look at the debt, equity, revenue and profit and see that they all go in the right direction. Okay,
You'll give a better example of that in the second part of this where we actually go into the stock review about that.
We're going to go real deep dive into a stock and we're going to get everything live. We're not going to look at it beforehand. In fact, I'm literally going to say next week for Ryan just to grab any stock he wants. Yeah. So it's going to be completely live for you. And the next one is competitive advantages. Now, this one's really simple concept, but it does require you to do quite a bit of research. Okay, so a durable competitive advantage is when a company occupies a business space that would be hard for a new competitor or established lesser competitor to get ahead of them or occupy the same sort of space in the market. Now, some ways companies do this is to build such a highly respected and known brand that customers just wouldn't want to switch because they know they get what they need and when they need it from the company they're with. They also could have things like intellectual property or copyrights that block competitors from getting close to their technology or superior product. They could even build in switching costs so that your consumer contract kind of strong arms you into staying. You need to pay X amount of money to leave us, and that does make people stay. I feel if someone with a big contract, say you were in an automotive company and you had a contract for millions of pounds, but the switching cost was £500,000, that's quite a lot of money to be wasting on switching companies. What is the saving gonna be? And it kind of brings people back in. Now, the one that I really I don't know whether I agree with it or not, is the high startup costs for new competitors. At the end of the day, if you set up slowly, you can bring your costs down per year and eventually take over the market leader or second market leader, and you can get there in a way that's not a massively high startup cost straight away. But it does stop people from thinking, oh, today I'm going to start a business doing this. I'm going to put X amount of millions or billions into it. It makes it a lot harder. So people will probably shy away from that.
But even still, it's almost the modern way of doing it now. You look at all these unicorn companies, let's say Tesla, Uber, Lyft, all these companies, they have been running at billions and billions and billions of pounds a year at loss. Tesla is a really good example of that. And now all of a sudden, Tesla's now getting to the stage where it's almost market leader in the sector. They're starting to turn a profit. So for starting an automotive company is one of the highest startup costs you can possibly have, because the amount of infrastructure that has to go into building cars like that is insane. But Tesla's proven that you can indeed do that. So
and you can, and they I wouldn't say that they did obviously had a massive startup cost, but they have done it in quite a systematic and progressive way rather than just jumping in heads first and going, we are the market leader now. They've kind of gone, we're going to be the market leader, and now they kind of are. Okay, so next up we have the payout ratio, okay? So this is about how much for your share are you getting in return compared to how much the company itself is earning for every share that someone owns in the world or they have published. Now, the majority of broker sites we've looked at in our first Getting Started Guide episode had at least some information regarding the financials of the company. And within this information, you'll find this part of the strategy. Okay, the payout ratio is sometimes needs to be calculated. So I'm with eToro, and I have to calculate the EPS. But at the end of the day, I don't need to put it into a calculator. I just need to know sort of where it's at in reality.
You can always go
It tells
online
you,
and find it as well, so it's not necessarily
yeah,
calculated. There's other sites available
yeah,
that will have it on there. I mean, Google's
yeah,
investing page
exactly,
itself has it on there. If you type in X
yeah.
stock, it's normally on the very first hit. So
Mm. No, so I use eToro, as I say, and I use that as a quite a all-round kind of system. Obviously, I'm using my annual reports and quarterly reports and Dividend Max. Other than that, I don't really do anything else off eToro, if I'm honest, because I know I can get my EPS, which is my earnings per share. I know I can get my dividend per share, and all I need to do is take the dividend per share and divide it by the earnings per share, and I've got my payout ratio.
mhm.
I don't need to know that it's 1.2539. I just need to know that it's about one and a quarter. It's about 1.5.
Mhm.
As long as it's above that 1.2 sort of area, we're in happy zone. We're in a nice. It's a nice number to see when you're doing your payout ratio. If you're seeing 1.5 or better, then great. If you're seeing 2, 3, 4, 5 and or more, amazing. They've really covered their dividend payout, which is great.
Yeah,
Um,
it's important. It's a really important point. This one, it's so important because if the company's below one, it's not paying out a dividend. They're paying out more money than they're earning, so that dividend
yeah.
isn't going to be sustainable. The company's likely to
Mm,
cut their dividend. Your dividend percentage ratio is likely to go down, and it could cause danger. Now, if you're investing in a riskier stock where the dividend ratio is already, or dividend payout ratio is like 15% already,
mm,
and they're paying out less. If you can
yeah.
work out what the cut is and it's above 4% and it's healthy, then yeah, okay, it could still be a good investment. So there's some calculation you do there. But generally,
Yeah.
when forming the backbone of your portfolio, as Liam's put the numbers on screen here, is that 1.2 and above is crucial, because if it's 1.2 and
Mm,
above, it's generally sustainable and the company can keep paying you that money and feeding you those dividends.
yeah. As a rule for myself, I will, if I have say 5 stocks that I'm looking at in a session, then and I've got 3 that are roughly 1.2. I've got 2 that are roughly 1.4, 1.5. Then I'd rather put more money into the 2 than split it across the other 3.
Mm-hmm.
You know, I'd rather try and aim for that higher earnings per share, because it's a nice feeling to know that you've got quite a safe dividend yield as long as they
Absolutely.
continue earning at the same rate. I was
Absolutely.
looking at a dividend the other day. It was 8.6%, but the dividend rate, the payout ratio was 1 exactly.
Yeah.
And I thought, okay, so it's not going to be 8.6%, but
Mm-hmm.
it could be 6.5, 7%.
Absolutely.
If they drop the dividend. So actually, is it a bad investment in that case, or I'm expecting a lesser dividend, but I'm not expecting it to go down to 3%. I'm expecting it to be in the 4 to 5, maybe 5.5% range, which is a perfect spot for me.
And that's exactly the right thinking. It's not just look at the high level numbers and go, that's great. It's have a look and go, well,
Mm,
why is that number what it is? Is there a
yeah,
reasoning behind it, or is that number at risk? Have a bit of a deeper dive,
yeah,
which you can find in all the fiscal reports. The information is there. It just takes a little
hmm
lateral thinking, and then you can go, oh right, actually, okay, this could still be a good investment, or okay, this looks good on paper, but actually, it's not looking so good
yeah.
going forward. So
Well, that leads perfectly on to my favourite part, and that's when we look at the dividend yield, and you just see that percentage, and you go, money.
money.
At the end of the day, it's what it all comes down to. We want to see that percentage in our average sort of area. I mean, how much are you going to make? I mean, we aim at TPP for an average of about 5% yield across our portfolio, maybe 4.5. Around there is a great number in my head, and I think that you're pretty much the same on that, aren't you, Ryan?
Yeah, mine's generally slightly lower towards the
Yeah,
4% just for extra security, but I think my
yeah,
projected yield for this year is 4.24, so it's in the ballpark.
yeah,
4 to 4.5 is
exactly.
sensible.
At the end of the day, the higher you can get it with safety in mind, having safer stocks to offset risky stocks and that sort of thing, then the higher your dividend yield towards that 5% target, great, you're earning more money. Just make sure that you're, thinking about the stocks you're investing in.
Hmm.
If you do want to work out what percentage yield you've got. If your site doesn't give it to you, you can always check out places like Dividend Max or even Google Invest, or I think Investopedia do it as well. If you need to work out your percentage yield because it's not given to you on your broker, or you don't know where to find these websites that tell you instantly, then you can work it out really easily. All you need to do is take your dividend per share, divide it by your current share price, and times that by 100, and then there you have it. You got your yield for that stock.
What you generally find as well, if the longer you hold these things, if you haven't invested any more and the dividends keep growing, that yield's going to keep growing because the entry point is lower than the current share price. So, best example of that is the king of dividend investing, Warren Buffett. He bought Coca-Cola, and at the price he bought Coca-Cola, he gets about £400 million in dividends from Coca-Cola a year, but he only paid like 40 million, let's say, for the stock. I don't know the two numbers. So technically, his dividend yield is 1,000%, which is ridiculous.
Now, just because we're dividend investors, that doesn't mean we're always trying to look for those companies that have that 4% dividend or 5% dividend. We also invest in companies with 1 or 2% dividends, because in a lot of cases, these are actually the safer stocks. Like we explained a few videos ago, we had like the New River stock, which had a nice dividend, and it was, it was going to have a nice growth as well, we thought, but it was risky. So we said to offset it with a safer stock like Unilever, which was our episode after that. If you haven't checked those out already, make sure you do, because they teach you a lot about risk to reward, okay? One of the main things for me is you need to have your safety net. Now, this is really important. You need to have that money in the bank ready to ready to pay things that are like, you lose your job, you need to live for X amount of months until you get a new one, or you need to buy a new car, or other things around the house that are important. I think that's very important, and we need to. I think we touched on that in another episode previously in the Getting Started guide. Something that I really want to say is never, ever, ever take out a loan to invest in stocks. Never remortgage your house to take out to invest in stocks. Never do something stupid to invest in stocks. It needs to be money that you have effectively spare. I know that's hard to say for some people, but if you've got your safety net and you're putting a reasonable amount of money in there each month for your insurance or your house insurance or bills and that sort of thing, the rest of the savings could go into investments. I mean, that 5% a year is beating inflation.
That's the goal. Absolutely. I think the big thing is with this, with picking out your stocks, is the first thing you need to do is, as I call it, get a heartbeat to your portfolio. I like to look at energy stocks. I like to look at insurance companies. I like to look at consumer essentials, basically things that people can't live without. The companies have been around for years. They've always paid out a dividend. They've always showed slow dividend growth in a 3 to 4% range, and you build up that heartbeat to your stock.
Yeah.
And then what you can do,
as we said earlier,
exactly,
mature stocks.
Mature stock, exactly it. But then what you can do is, if you're on the side of our own, obviously, if you've got young and you've got time, you can go into the slightly riskier side of things. So that's what exactly as you mentioned. We start talking about New River, where you might look at it and go, okay, it's an 8-9% yielder, but I've looked into the financials and I think they could have a good growth forward, because the risk reward, as we're talking about here, is where, yes, it's higher risk, but it's also a higher reward. So if it pays off, your portfolio and your dividend yield goes up massively as you go through it. So just make sure you build a heartbeat. Pay maybe 60% of your portfolio goes toward, right, this is the most boring part of my portfolio, and 40% goes towards your, right, okay, this is high risk, but offers me high yield, and maybe I could retire early because I've done better on it. And then as you shift through your life and your portfolio gets more mature, you generally graduate away from the riskier stuff into the more mature stocks 100%, just because you have got less time to recover from a risk, if that makes sense, or a failure.
Yeah. Also, when you get close to your retirement age, why do you want to be sitting on a computer going, oh, I can sell this today or buy this today and sell it tomorrow and earn some money, when you could just chuck money in each once a month and never look at it? Exactly. Just keep seeing those dividends coming in.
And this is exactly what pension portfolios do. Eventually, they shift a huge amount of their money, something like 80% of it, over towards the bond market. The bond market pays you a couple of percent, but it's very, very, very low risk, because the government is seen as a good, safe investment, because they will always pay their bonds, because they just print more money if they can't pay them. So.
But then also the value of that money goes down.
Yeah,
so...
exactly. You get hit by inflation, but the bonds are seen as safe, and this is why we will look at the yield curve for bonds at some point way further in the future. This is why when there's a market downturn, you'll suddenly see the yield on bond that takes a nosedive because everybody's taking their money out of stocks and into bonds as they're seen as safer.
Mm, mm. So, guys, I hope you've learned something from this today. Our next episode in our Getting Started Guide to Investing should be next week. It's the TPP Investing Strategy Part 2. That is a live example of these techniques in action. We're going to pick a random stock and we're going to run with it and see what happens. We might even end up putting money in it at the end of the day. You never know.
I'm going to enjoy editing that one.
Please add our socials and Discord for various updates. They should be below in the description. Please hit the like button, which I think is here, and the subscribe button, which is over there. I don't know. And follow our investment journey and also improve yours. Thank you for watching the Portfolio Podcast.
See ya.